Joining me today, Mark Jarvis, CEO and Chairman of Giga Metals, and Lyle Trytten, Manager of Development for Giga Metals. It's Mark. It's nice to see you again, and Lyle, it's nice to meet you. How are you guys here today?
Very nice to see you.
Doing well today, Matt. Thanks.
So they're here representing Giga Metals. Giga Metals, it's September 22nd here. Big news out today. Giga Metals has published their PFS, and who doesn't love a good economic study? So I thought I'd get these two guys on here just to chew on it with me a little bit. Before we get going, though, as always, standard disclaimers, right? This is not investment advice. Information here is entertainment purposes only, rather, and you have to make your own investment decisions. Full disclaimer in the YouTube notes. But Mark, why don't we just kind of start simply put? You've got a nice new slide deck out with some highlight numbers from the PFS. Do you just want to do a quick slide deck presentation for us here to get us going?
Yeah, and I think it'll only be part of our deck. I don't want to get into the whole nickel market. I assume your audience is here because they already know about the nickel market and they know about the EV market. So I just want to be specific to this project for this part of the presentation. So I'll just get going if that's okay with you, Matt. And
Yeah, absolutely.
part of it'll be me, part of it'll be Lyle. There's certain parts that I want. Lyle is our in-house engineer who worked very closely. He was our point of contact for all of the various engineers, geologists, and metallurgists that worked on this PFS. And it's been a lot of work. Lyle has been in the middle of all of it. So he's the guy that knows all the details here. So just so you know, I'm the guy that understands things from about 20,000 feet, as they say. So I'll just get going. I've always been a fan of this picture because it does a really good job of showing, there's the camp, there's the kilometer-long airstrip, there's the Turnagain River, but it also shows the terrain. This is good country for open pit mining, and it's also easy country for road building. This is not challenging terrain by any stretch of the imagination. So this shows that very well. You'd made your disclaimer. Here's our disclaimer. So we formed a joint venture with Mitsubishi Corp, and it's with Mitsubishi's money that we've actually done this pre-feasibility study. They were very interested in the project because low carbon, and also, they liked the jurisdiction, but they also liked, they looked at our PEA, which you'll recall, Matt, had a negative depreciated net present value on it, which everybody was shocked when we released that. Like, why don't you jigger it a little bit? And we don't do that. So we just put it out. We tell it like it is. And this PFS is much along the same lines. It's not designed to get, Bay Street and Wall Street, analysts excited. It is designed to describe accurately our project to potential strategic investors. That's the market that we are focused on right now. So, and that's why we've done things the way we've done them. I'll just move on here. So here's some of the project highlights. The capital cost, 1.9 billion, is similar to the full capital cost of the PEA, and it's interesting because there has been inflation, in the intervening. However, the engineers, this is a capital cost with a higher degree of certainty because the engineers actually went out and got quotes on all the major equipment and have done detailed, much more detailed design work than in the PEA. And this is a good number, and this is a credible number. Now, instead of building it in two stages, 5 years apart, as we did in the PEA, it's basically we're going to build the first stage and then immediately start building the second phase. So within the first year, we'll start building on the second phase. And the reason for that is that the initial capital cost went up and the capital cost to double production went down. So we weren't going to be risking that much less capital to actually go full steam ahead here. So that's why we changed that approach. Very large mine, roughly 35,000 tons a year of nickel and about 2,000 tons a year of cobalt in a typical year. And just for perspective, for a large Indonesian HPAL project, that'll get to 35,000 tons a year of nickel, the capital cost is typically around $3 billion US. So, 1.9 billion is a very large number, but in the scheme of things and in comparison with the competition, it's actually quite affordable, if I can put it that way. A 30-year project life, a beautiful high-grade concentrate, site operating cost of $3.85 a pound nickel in concentrate at the mine gate. That is before byproduct credits. It's also before shipping charges. So if you fold in byproduct credits, shipping charges, and smelter charges, you get the C1 cost, which is US $4.65 a pound nickel. So that's $4.65 per payable pound. And the smelter's paying us 78% of the nickel content and 50% of the cobalt content. And again, the reason we went that route to the smelter route is that it's a market that exists. It's existed for 100 years. Smelters have been buying concentrates like ours. And in fact, most of the concentrates they buy these years are much lower quality than our concentrates, but they've been buying and successfully processing for 100 years. So we're focused on a market that actually exists. We do think the future will be for material like ours to go through a pressure oxidation refinery, but there's not that many of those around. So we're not going to model that in an engineering report at this point. We do believe the future is there, though, but people have got to start building refineries. And so for these technical highlights, I'd like to pass it over to Lyle to comment.
Sure. Thanks, Mark. When I think about this project, and I come from an operational background, is I want to build something that I know it, and I know it will work, and I know what it will do. As an operator, you want to know every day that it's going to do what you want it to do. So the fact that we have a very simple flow sheet, once through, crush, grind, standard froth flotation, much like a big copper porphyry project, except even simpler because we have one recovery mode, froth flotation of the nickel concentrate. We don't have to worry about a second con like a moly concentrate or doing an acid heap leach and stuff on the side. It's just a very straightforward flow sheet to recover the nickel. Cobalt comes with it. A little bit of the PGEs come with it. There's nothing fancy being done there. Standard technology. One of the big questions we had coming into this program was we've done a lot of work over many, many years, decades on the whole recovery program. We've seen a wide range of results. And the question always is, well, maybe that's just your best stuff. What about other stuff? How will it all work? And does it all behave the same? Do you understand how the whole deposit will behave? So we set out to do a big geometallurgical program, work with some experts in the area to pick 70 samples from around the deposit, all spatially all over the place, different rock types, different grades, all the way from high-grade ore down to what we know will be waste material, and put it all through the same standard process flow sheet to see what would happen. And we were very surprised with the outcome and very pleased with the outcome, because what we were able to do was show that every sample is described by the same recovery algorithm. The host rock type doesn't matter. Where it is in the deposit doesn't matter. We need to know a couple of points about the rock, and that's it. We can predict the recovery with a very high precision algorithm, much better than is typical for low-grade nickel projects. So, that's a really great outcome that allows us, when you go to operate the project, you know what you're going to put in the mill tomorrow because you've done your definition drilling, and you know what it'll come out the other end. From a mining point of view, it's a big mine, 90,000 tons a day of ore, but it's a very low strip ratio. Life of mine is 0.4. It was a little bit lower in the PEA, 0.2, and it's changed. It's gone up, doubled to what is already, what is still one of the record low numbers because of two factors. In a PEA, you're allowed to include inferred resources in your overall project plan, and in a PFS, you're not. So those inferred resources are now waste on paper, in reality, when you dig it up, if it's of ore grade, you'll process it. And we've been more selective about more marginal materials. Our recovery algorithm is giving us better precision at the low end to better define what's ore and what's waste. And that means that some of the materials that were considered marginal ore before, we're now considering to be waste. But again, those decisions change every day in an operating mine based on price points. Nickel goes to $20, most of that waste is not waste anymore, right? That concentrate that we produce, as Mark said, is a great con. Typical in our industry is 10 to 12% nickel. You end up bringing a lot of lower grade materials with it, like pyrrhotite, because that contains a part of your nickel. And to get high recoveries, you end up with low grades. Because we've got 99% of our nickel, recoverable nickel, is in nickel sulfide minerals, pentlandite primarily, and a little bit of other minerals. That's what we want to recover, and we can reject the pyrrhotite. So if you're in a Sudbury camp type environment, you typically have a bunch of that in your concentrate, dilutes you to 10%. We don't have it in ours. That allows us to really tailor the operation. Overall, the operation is a very low carbon throughput. The GHG profile is very low. It was very low at the PEA at 2.24 tons of CO2 per ton of nickel and concentrate. We've dropped that to less than 1.8 now through some selections in our mining equipment and our approach to bring that down a little bit further. We're using more electricity and less diesel. And in BC, I think that's a fantastic story. Not included in that is the fact that our tailings, the host rock that hosts all our nickel sulfide, are actually reactive with CO2 from the air and will sequester CO2 in the tailings when it's exposed to air. We haven't accounted for that. You can't know ahead of time exactly how much it will be, but it will be an appreciable amount. And at the end of the day, that's a good thing for the world.
Okay, so here's the economics. And there's one surprising result in here. So just for context, a couple of things. We chose as a long-term price $9.75 per pound for nickel. And just for context, that is 19% below the 20-year average nickel price in 2023 dollars. And I'll be showing you sort of a high and a low case of sensitivity analysis in the next slide. But even our high case in the sensitivity analysis is still below the average nickel price for the last 20 years. So, it's we think that's a pretty conservative price. One thing that people might question is that we're using a discount rate of 7% rather than 8%, which is typical. Why are we doing that? The reason we're doing that is that we've got Mitsubishi for a partner. And if this mine gets built, the cost of capital will actually be well below 7%. I think they can get things built, with, at a 2 or 3% interest rate. So this discount rate, when you look at who we're in business with, is actually on the high side. You could make an argument that it should be lower under the circumstances. And then people look at the surprising results here is you've got a pre-tax internal rate of return of 11.1% and a post-tax internal rate of return of 11.4%. That result we found quite surprising when PricewaterhouseCoopers came back with the tax analysis to us. And Lyle, you can probably do a better job of explaining why this arises than I can.
Yeah, it's really an outcome of the new clean technology manufacturing tax credit that the federal government has brought in. This is in order to remain competitive with other jurisdictions like the US with the Investment Recovery Act and some of the stuff they're doing in Europe to encourage domestic manufacturing and build those critical minerals supply chains. And so the CTM tax credit, regulations aren't fully published yet, so everybody's guessing a little bit, but we've worked with our accountants on this, and it's a refundable tax credit. So in actual fact, we get a portion of the capital cost back from the government as tax credits at the start of production, not 10 years down the road when we're making good profits and have paid off all our capital costs. And that bumps your post-tax numbers up, which is great. We love that, and our government, every government in the West, is very concerned about these supply chains, and is very concerned about making sure that we're able to be competitive with projects in the West. So they've taken the steps to do that, and you can see the results here.
Yeah, it's great. And also for a bit of context for the viewers, if you've got a really large base metals project, something with a 30-year mine life, and with potential upside far beyond that, which this one does have, the hurdle rate is really an internal rate of return post-tax of about 10%. It's not a 20% or a 30% hurdle rate to get the project built. So we have exceeded that, and again, with a nickel price that we think is quite conservative, considering what's going on in the electric vehicle market. I know that the nickel price the last week or so has been off. There's a lot of concern about what's going on in China, but that's, nickel does that. It goes up and down in quite a volatile way. Long term, it needs to trade at higher prices to incentivize, all of the large low-grade deposits and the HPAL deposits. They need higher nickel prices to deliver robust economics. So there's a little background of that. And here's the sensitivity analysis I was talking about. And you can see how, if you look at the depreciated net present value, if you take the price to $11.22, which is, again, still below the 20-year average price of nickel, now you're getting into a post-tax NPV of more than $1 billion US. So this is getting very robust. And you look at these numbers, and on the base case, post-tax NPV at 574 million US dollars. My God, look at our market cap, and our market cap looks like the post-tax depreciated net present value if you assume the low case, 15% below the base case. That's what our market capitalization looks like. And so basically, if you think we're worth what we're trading at right now, then you believe that the long-term price of nickel is much lower than we believe it is. So here's where we're located. It's a good jurisdiction, lots of mining in this jurisdiction, lots of big open pit mines. And that dotted purple line shows where, the solid purple line, first of all, is where the BC Hydro line is built today to the village of Iskut. And we're going to need to take it up to Dease Lake and over to our project. So, basically, and then the highways there. We're also going to need to build out the road in to Turnagain. It's a very primitive road at this point. So part of our capital costs are to improve that road to make it suitable to support a mining operation. We are in a territory that is claimed as traditional territory by both the Tahltan and the Cascadena, and their claims overlap at our project, and I think there's pretty wide agreement amongst both the Tahltan and the Casca that it's going to be a 50-50 deal. Both of them are generally supportive of responsible mining development. They're doing quite well out of the mining business right now, and they continue to do better. Lots and lots of good jobs. The mineral resource statement, you can see that we've got in measured plus indicated, which is all we used in the PFS. We've got a total of 7.4 billion tons of nickel, and then in the inferred category, another 5 billion tons. And something new here in this PFS, we now have reserves. Reserves are different than resources. Proven reserves are if you take measured resources and apply an economic analysis to them, and with a positive outcome, then they become reserves. Probable reserves are the indicated resources that have gone through that same process. So in total, we've got 950 million tons of reserves with 4.3 billion pounds of nickel contained. So truly a giant project. Now I talked about upside. If you look at the Horse Trail zone, Horse Trail in Northwest, that's where we're going to be mining. And you can see the density of the drilling in there. So that's where the reserves are. We didn't model mining the Hatzel zone. We could have, but at this point we're not going to. We think the Hatzel zone needs more drilling, more definition, but there's some pretty good grades in the Hatzel zone. The Cliff zone, we've got a few holes in historically. It's interesting because it's got nickel and cobalt, but it's also quite high in platinum and palladium, and it's got some copper grade going in there as well. So it's a bit different. Now, up in the Highland, the Central, the Mandible, we've got holes that are, as much as 3-4 kilometers away from our resource. And those holes are kind of similar to what's in the deposit. So we've just never had the budget to really chase all these other targets. But we think over time, there's a possibility, I would say a strong possibility, that you're going to develop more resources. You can't prove it until you do the drilling, but any geologist that looks at this goes, yeah, these are targets that should be drilled. There's a real case to be made that you could expand it. And so, we think once you get this project off the ground, the mine life will ultimately, it'll start at 30 years, but it will grow from there. And Lyle, if you could talk about the flow sheet here.
Certainly, Mark. Thank you. So I've introduced this flow sheet a little bit already. A few things I'd like to point out here is, we've got the primary crusher right next to the mine. Shorten the haul distance. You always want to do that. But then we're taking the ore after the primary crusher across the river and up the hill to where our processing mill is. And we're doing this using a big overland conveyor to put it into a crushed ore stockpile. And I really like this because as a metallurgical engineer, I've seen a lot of pipes hole out over the years. And when you put a hole in a pipe that's got high pressure slurry in it, you tend to get high pressure slurry everywhere. And it gets to be really hard to clean up. And you don't really want to do that into a river and a water course. So the fact that we're conveying it in a covered structure, spills of rock are much easier to clean up than spills of slurry if you ever have one. And then from the crushed ore stockpile, we're into our main processing plant, which is a very straightforward approach. Very conventional cone crusher, secondary crushing circuit. Tertiary crushing, we've done something a little different for the Canadian-based metals industry. We're using high-pressure grinding rolls, which are a very energy-efficient way of getting that finer stage of crushing of the material. They're amazing devices. We put about 1.5 tons of material through a pilot unit at the University of British Columbia this spring. It was amazing to watch it work. It's unlike anything else I've ever seen in the minerals business. Comparatively speaking, quiet, dust-free, just sucks material through these two counter-rotating rolls and crushes at the very fine material. So we went from about 1-inch size particles to about 1/4-inch size particles. In 20 seconds, we could suck through 200 kilos. Amazing devices. Very pleased to be using them because our ore is hard. And so that comminution energy is important for us. Coming out of there, a couple of closed circuit ball mills to get down to our final product size of 85 microns. That's where we get the best recovery. I'd love to have an ore body like the copper porphyries that you can get away with grinding to 250 microns and recover it there. That'd be brilliant. That's not the Turnagain ore body. You need to do what's right for the ore body. Rougher flotation is a big circuit, and that's really important. That's our primary recovery. If we don't get it in the rougher flotation, it's going to tailings. So you really want to make sure that you push really hard in the roughers and pull off all the floatable nickel you can. And then you take it into the cleaners and you start scrubbing away all the stuff that isn't product. And that's the job of the cleaners and the cleaner scavengers that we have in the flow sheet. Once through that whole circuit and the product comes out the other end of the thickener and filter and off to market, tailings out of both the roughers and the cleaner scavengers are all impounded in our engineered tailings management facility, which is a really interesting structure and design point because that's where we have our carbon sequestration aspects.
And if I can comment as well, simplicity equals low risk, low technical risk. And in fact, I would venture to say that of the large undeveloped nickel projects of the world, there's nothing out there that has a flow sheet that's simple, and therefore there's nothing out there that has a technical risk this low. So that's a real strength of the project. This concentrate is a beautiful product, and so partly we can sell it to a smelter easily, and one of the attractions of our product to a smelter will be that they can take our product and then they can buy some cheaper, dirtier concentrates and blend away the problems with the cheap stuff by mixing it with our stuff and making something that's suitable for their particular smelter. But again, there are clear options that you can take this through a pressure oxidation circuit, and take it sort of directly in the direction of the cathode. There's just not enough refineries built in the world right now, unless you want to ship to China. And, I think the governments and the car companies are pushing not to ship this product to China, that this should be part of a North American and European supply chain. And again, there's our annual production model out. It's a giant project. And we're getting into stuff that's off topic for our specific projects. So I'm going to stop sharing right now and we'll start taking questions.
Yeah, perfect. No, thanks for that, Mark. I think that the just new PFS, everybody just wants to see the headline numbers as best they can. But yeah, you touched on, both of you, a couple of topics that I hope that we can kind of fill the rest of our time with here today. I think that people are going to want to discuss the headline numbers. People are going to want to discuss maybe under the hood all those characteristics and aspects of the Turnagain project that merit a closer look for investors. And what I find interesting here is, and I'll touch on this later, is trying to change my perspective, look at things from the perspective of a major versus just a private investor, right? And there are different characteristics, different aspects, a different checklist at play there. But maybe before we get into all that, cost improvements, right? Like I think you referenced it. I mean, we've seen some serious inflation. This has always been a risk in the last few years, chronic risk always, but especially in the last few years, that economic studies are out of date very shortly when it comes to that pricing. I just crunched numbers. I looked at your PA this morning, and my numbers might be a little off, right? My math might not be perfect, but your CapEx, as you referenced, Mark, stays roughly the same, but your sustaining capital, you're actually some significant savings, so that when you go to get the total capital expenditures, there's $377 million US cheaper now than there was on the PEA from a few years back there. So that's 9.6%. Can one of you gentlemen, I'm not sure, maybe this is a Lyle question, but how did that come to pass, right? Do you mind just touching on that a bit?
Sure. And so there's two things that I want to stress here. Typically, when you move from PEA to PFS, you see costs rise. And there's an old maxim in the industry that a project never looks better than it does at the PEA. We deliberately set out with the PEA to do a conservative project. And that's what got us Mitsubishi. That's what got us numbers that the retail crowd didn't like. It's okay. We did what we wanted with that. You'll see that the headline capital number for the construction capital is basically the same now as it was 3 years ago when we did the PEA. And, some of the elements have gone up in cost. When you look at the direct costs for the process plant, they're up a little bit. For the mining, they're up a little bit. For the offsite infrastructure, they're actually down a little bit because we're doing a better job of estimating. Whenever you go to the next stage of detail, you're getting a lot more engineering information to build your estimates off of. And so the last time, these were really just broad factored estimates. Oh, we need a 78-kilometer road. It's going to be about this much a kilometer. Well, now we've actually gone through and calculated cut and fill quantities and how much work needs to be done and looked at all the crossings and come up with a lower number. Same thing for the power line. We've come up with a lower cost. So some of those have helped offset rises in some of the other equipment packages. The big change, as you referenced, is in sustaining capital. And that's really, it's a two-part answer there. The biggest part of that is simply it's a shorter mine life. It's 30 years instead of 37 years. So you don't need as much mining equipment. You're not putting as much tailings in the tailings pond. On a per ton of ore basis, the total capital cost for mining and tailings management is about the same as it was 3 years ago. So why is there no inflation in there? Because we built it conservatively in the first place. People were surprised. And when we've gone back and done the details and dug in really hard on the work, these are the real numbers, and we're quite happy with it. We brought the contingency values down as the direct costs have risen because you're able to do that when you have that higher level of definition. And the engineers, they've got quotes for all the major pieces of equipment. They've done detailed builds of materials for all the installation requirements, all the piping, all the wiring, all the instrumentation, all of that is no longer factored off. The pump's $100,000, so it'll cost us $350,000 all in. It's now done on a much higher level of detail, which allows you to bring the contingency down. The indirect costs, which are all those bits of cost that you incur that don't end up in the final plant, engineering, procurement, craneage, temporary facilities for workers, all these kinds of things. That cost has actually stayed the same from PEA to PFS, about $375 million, right? And we think that for a remote project, that's probably pretty real, right? Could we get it down a bit? Yeah, perhaps, but you don't want to try and say it's going to be $100 million because there's just no way to build a project in northern BC that remote that's going to have that kind of indirect costs. It doesn't work.
Without naming names, I have seen engineering reports out there for similar size projects where the sustaining capital life of mine is $50 million. Nobody believes that. Nobody in the industry, nobody that's ever run a mine, nobody that's ever run maintenance in a mine believes that. But these are the games you can play with these kind of engineering reports. And we're not playing any of those games. Basically, we're looking to the strategic market and saying, A, do you believe our geological model? B, do you believe our metallurgical recovery algorithm? Do you believe our CapEx? Do you believe our OpEx? Do you believe our sustaining capital? Those are the things that we have laid out in great detail. They can do all the due diligence they want on them, and they're going to plug in their own assumptions about nickel prices, payabilities, so forth. They've got their assumptions about that. They don't care what we think about those issues. They just care about, have you nailed what this thing's really going to cost?
And I think so. Mark, I guess the one thing that I always do when I'm looking at sort of comparator projects, and it doesn't matter the mineral you're dealing with, the cost of mining is the cost of mining. And so if you're going to run a mine that's 50,000 or 100,000 or 150,000 tons a day, you need a lot of mining equipment. And what's key is what do you think the total sustaining capital is per ton of total material that you're mining, ore plus waste? That should be relatively the same from project to project. So if you look at our numbers and you think they're high because you're comparing them to something else that's a lot lower, well, maybe that lower number is the right number. Fine, use it. If you think so, use it for us. If you think our number is more realistic, apply it to other projects. But the cost is the cost. Nobody has any magic that says that our mine trucks will last 3 times as long as somebody else's. Like, that's not how the industry works.
Yeah, and also those gigantic tires on those trucks will last 3 times longer.
Yeah.
No, they won't, and they're expensive.
No, and Mark and I, you and I have chatted a few times at this point, Mark, and I appreciate always your frankness with this, right? That I think that that you're that kind of that brutal honesty that you're coming to your own project with, I find so interesting. This is what I referenced earlier, is that it almost creates this oppositional approach between retail, who look at IRR and NPV and payback and might balk at what they see here, but then that's what I always find so fascinating is that, like, yeah, you've got Mitsubishi, you have a major, you have that the ultimate rumor that every nickel junior wants is this big fancy automaker to strap their name to it. and you've got that. And so it always gives me pause, right? How should I be approaching this project? Am I approaching it incorrectly in terms of an actual value judgment? I just wanted to keep going here, though. In terms of just changes from PA to PFS, sorry.
Before we move on, there's
Yeah,
one
of
thing I
course.
want to clarify is, and a lot of people make this assumption that we're dealing with Mitsubishi, the car company. We're not. Mitsubishi is a huge conglomerate, and there is a car company within that. But we're dealing with, in the larger sense, we're dealing with the trading arm, with the commodities trading arm of Mitsubishi, which is the largest commodities trader in Japan, which has some other very large commodities traders. And then within the commodities trading arm, we're dealing with the raw materials division. And then within that division, we're dealing with the battery materials division or subdivision or whatever it is. But we are a long ways away from the car company. Our material may or may not end up being sold to Mitsubishi Motors. Frankly, it probably won't, unless it's to a plant in North America. It'll likely go to other automakers. So that's an important point to make, because when we're talking to automakers, they don't want their competition in the same deal. So anyway,
No,
so sorry about that. I interrupted you, but go ahead.
No. I will clarify and remove the auto comment. Yeah, precisely. It's still a huge multinational corporation. Provides a shuttle legitimacy that Ni-Co juniors wish they had all the time, right? Just questions again around the PA to PFS changes. Lyle, maybe just briefly here, there is a reduced mine life from 37 to 30 years. My question I had prior to you talking, and maybe it sounds like maybe I'm a little off here, is that simply a removal of the inferred from the mine plan, or what? How does that come about?
Yeah, it's two aspects. Part of it is the removal of the inferred. You're not allowed to incorporate them at the PFS level. So we have 53 million tons of inferred in the mine plan that are going to waste right now on paper. Of course, in practice, if they're ore grade, you'll feed them into the mill, not stick them on the waste pile. The balance of it is that as we've tightened up our recovery algorithm, we're being a little bit more selective about ore versus waste, and low value, what we thought were marginal low value materials for late in mine life production are now being slated for the waste pile. They might be economic depending on the price at the time, but under the paradigm that we built the model under, they're slated for waste. Ultimately, most of our waste material is mineralized material. It's just whether it's got enough grade to make it worth putting through the mill or not. And that's a decision of the day when you're mining it. Do you put it through? Do you put it in low-grade stockpile, or you put it in the waste if it's a low-grade item?
No, thank you. So yeah, again, just always with this, I'm looking at the PFS. I mean, the full PFS isn't yet released, right? Just the highlight package here. You have changed, and you folks reference it, and again, I just appreciate that sort of upfront approach. You changed the discount rate from 8%, which is standard for base metal, to 7%. And so I worked backwards with some napkin math based on PEA sensitivity charts. There are still significant improvements on the valuation, even at an 8% discount. And I can even understand, what your expression of reduced risk, transition from PA to PFS, Mitsubishi on board. I do buy that, right? I understand that is a reduced risk that could merit or warrant a reduction in the discount rate. But people might still raise an eyebrow, I suppose, right? That it challenges the ability to do that sort of one-to-one comparison, just like I found, right, from PA to PFS. Do you guys just want to discuss, gentlemen? Do you want to discuss who had input into that change? I guess maybe was Mitsubishi involved in that discussion at all? And then is this an external? Was Tetra Tech involved with that? And how did you come to justify or understand that the discount rate reduction was warranted?
I'll let Lyle answer most of that. My one comment up front is that the discount rate that you use to analyze a project is related to your expected cost of capital. Okay. And so if you're taking on debt capital from a Mitsubishi bank, well, we actually expect it'll be at 2 or 3%. And so 7% is high in relation to that. And your cost of capital is related to your jurisdiction as well. If you're in a dangerous country, the bankers are going to charge you more because there's more risk. So, we thought it was a reasonable move. But over to Lyle.
Yeah, thanks, Mark. And as a professional engineer, I resent the approach of there's a standard number you should use. I think it's complete BS. And if anybody can explain to me why the risk factors in a gold project are so much different that they get to use 5% and a base metals has to use 8% when all the risk is in the mine and the geology and the processing, I'd be pleased to entertain that argument. As it comes to the selection, ultimately, it's Tetra Tech because they're signing off on it. They are the QPs for the project. We have input. Mitsubishi has input. Everything that we've done has been in lockstep with Mitsubishi and their due diligence consultants that they've had on board from before they invested all the way through the pre-feasibility study. And we've met with them every month, and they've provided a lot of input and review of all of the elements as we go along. I think 7% in Canada with Mitsubishi as a partner is a very realistic number. I wouldn't say 7% for a project in the DRC was a reasonable number, right? But, if you're in the base metals game, you use a single number, it's complete BS. Ultimately, again, we're playing to the strategic audience. They're going to use their own numbers anyway, right? It's going to be about their cost of capital. Whether you're a car OEM or a big mining company or somebody else, you're going to use your own number. And we've been told by some potential partners that we've talked to that, we see what you're doing. We're going to evaluate it at this number. Sure. Absolutely. Do what you want. You're doing it for your investment. You're entitled to use whatever numbers you want to use. So
as long as you have...
Well, please don't pull your punches.
Tell me how you really feel, eh? Yeah. Well, I think, you articulated that prior to this too, right? That so long as those concrete numbers, your capital inputs are concrete and known, as you say, your potential partners will play with the numbers themselves based on those. So we are getting to, right, these headline numbers that we'll get to, IRR 11.4, et cetera. But we will get to those. But here, that's confusing me. I do want to talk about your project economics and your numbers, right? We see that you have these numbers that maybe what the retail investor looks like, that it's something that you're going to pass by, right? And it's something that I would want you guys to confront head on here as well, right? That your actual, the payback period, several 2 or 3 times more than what you would maybe expect around that 3 or 4 year mark, right? IRR is 11%, as Mark said. That the hurdle to that is 10%. These numbers it is economic, but maybe not the numbers that people come to expect from a project. And so for me, again, this is where, I know Mark has a history of success, and I find that you guys, I trust your numbers and I trust the way that you guys do your business. And so it makes me, and of course, Mitsubishi is this huge de-risking moment for me. And I kind of said off the top that it makes me recalibrate how I approach these numbers, right? So I guess, Mark, maybe I'll let you head this off, but Lyle, obviously I'll let you guys kind of take your pick. But if we're going to discuss this, this warrants a conversation, right? This is a massive, massive mine. Why are these numbers, even if you expand beyond economics, what does Mitsubishi look for beyond those headline numbers? I guess maybe that's the question I'm trying to ask you after this kind of ramble, is that what is the part of the picture that retail investors are missing that makes this compelling to majors or to large companies?
Okay, I'll start off, I think. So for one thing, the requirements for a huge long life base metals mine are different than if you've got a high grade small gold mine with a 7-year mine life. If you've got a little high grade gold mine with a 7-year mine life, you better have an internal rate of return of like 50%, because you're going to have, your models, you don't have enough time in that mine life. It's going to take 2 or 3 years before you really have shaken it down and you're really operating efficiently. And then by the time you get there, the mine life is almost over. So you need a really high IRR for that type of mine. I think what Mitsubishi looks like. Actually, I'm not going to speak for them. I think a lot of the larger companies and the majors, they look at the nickel market and they go, okay, I want a long mine life, because historically, nickel has been extremely volatile. Every 20 years or so, it spikes up to crazy prices for 2 or 3 years and then comes back to earth. And if you've got a really large mine in operation, then you're going to get 2 or 3 years of outrageous profits. I mean, I remember when Vale bought Inco. I forget what they paid. It was a few $billions. They bought Inco, and then in the 3 years following that, nickel prices went crazy, and their entire purchase price and then some was paid back in that 2 or 3 year period. So I think that's part of it, is that everybody knows that nickel's volatile. If you can get something built with positive economics, you are set up for when prices go crazy. And to me, when I look at the long-term price of nickel, I think we're on the edge of that. I think, I mean, right now there's headwinds because China is imploding economically somewhat, but this whole electric vehicle and overall electrification story means there's not enough nickel. Something's going to give. And I think, what everybody's looking at is that prices will go crazy in a volatile way for some period of time, sometime relatively soon.
Yeah, Mark, I think you nailed that one. I've been in the nickel business a long time. I started in it in 1993. Went through the whole Russian depression when they destocked stainless steel from all their defunct factories, and nobody in the nickel business makes much money in those years. You make your gravy in a couple of years, as Mark said, and those years are glorious years when you're a producer. You don't want to be starting your project up immediately after that. And that's happened a few times because, the history of our industry is you get funding when the prices are at their peak, and then you build your project and you start it up when prices have cratered, and then you struggle. And, we all hope for a different future. We can't put ourselves in Mitsubishi's head. They've invested for their reasons. But when I think about the other things that the Mineral Resources Group is invested in, it's things like Iron Ore Company of Canada, Escondida, Antamina. These are big, long life projects that operate more like a utility than a gold mine or something else might, where you're going to be making product at a rational cost for a very long time, and you make your money on that. And maybe you don't have the home run, but you're making a good amount of money just about forever. And that's what matters to companies that are investing for the long term. So, their track record of investing in long life projects stands on its own. That's what they've done.
Well, I think that's, it is forced me to have a thought exercise, as I've referenced a couple times, is to look at these things from the idea of, a major MNC like Mitsubishi, right? That, as you guys referenced, right, that if you're going to create this vertical integration, your supply chains, what are the goals? Are you in the nickel production business looking for, dollars per pound of profit, or are you in the battery manufacturing business? Are you in that OEM sort of style thing that they're going for, right? And so what do you want? You want consistent, you want predictable, you want simple, which I think, you fellows articulated that so well, that, I mean, your actual flow sheet is very simple, and that very narrow band of potential outcomes, right? It's jurisdictionally, it's low risk. And then, I mean, you also have one of the greenest and lowest carbon nickel projects on the market or in the world, I think, right? So it does make sense to me that major companies look at you as a way that they can reduce a variable and then build an entire manufacturing process on that product coming out of it, right? So I guess maybe not to just carry water for you and pump your tires, because I think that all that makes sense, right? But then to turn this around, where's the positive outcome for a retail investor? Someone is listening to this and they buy it, right? They can see that the perspective of a major company such as Mitsubishi is different than Joe Blow down in Canmore. What is it that where is that positive outcome? Where does that positive investment outcome, I guess, where does that start to take shape for you guys? And where does that start to take shape for us?
Well, I think I'll take a crack at that. Right now, um, it seems to me that the market for junior mining companies is broken, and it's right across the board. Um, and that's a whole topic of conversation that we don't need to get into right now. Um, but in our case in particular, we're trading at about a $25 million market cap Canadian. We've got a project with a post-tax, appreciated net present value of over 500 million US. There's a disconnect there, and so how does that value that's really there underlying all of this, how does that ultimately get expressed in the stock price so that people finally get to make some money? And I guess that's the real question. When we did our transaction with Mitsubishi, that transaction, when you look at the price that they paid, that implied a value of somewhere around 55 cents a share, something like 55 or 60 cents a share. And the stock traded up to kind of the low 40s on volume for 3 days, and then it gradually declined again. But, so there's a knowledgeable buyer getting what I thought was an incredible deal for Mitsubishi. I mean, it was a great deal for us because we got a great partner. But that did help, lift the price somewhat. The next tranche of financing isn't going to be as cheap as Mitsubishi paid, I can tell you that. And I know what my goals are. And so perhaps when we do our next deal with a strategic, and I'm confident it's going to happen. I don't know the timing exactly, but I know the level of interest that's out there right now, and it's for obvious reasons. If that transaction values the stock at $1 a share, or $2 or $3 a share, which all those numbers are possible, the market's going to react to that, I believe. I don't know if it'll, in a good market, whatever the implied valuation is from the deal that we do, in a good market, the stock would trade higher than that. In an okay market, it would trade around there. In a bad market, it will trade below that. But it's going to react to that, I believe. And then ultimately, will somebody want to buy this whole company? That's possible too. I'm not saying it's going to happen. And if it happens, I don't know when, but it's certainly a possibility, just to get their hands on this magnificent asset that we've got. And that's, of course, the ultimate crystallization of it, where the shareholders get to make money, and we all get to make money too.
Yeah, no, and I think I think a lot of people are maybe in the boat that they know Giga and they think it is this interesting project, but just the concern about that positive investment outcome for shareholders. Because I think, to me, if you ask me, will Mitsubishi, will Turnagain become a mine? I think absolutely, right. I think that for me, that the level of support that you have and the level of certainty that you've created, it seems like it's clearly heading towards a positive construction choice decision and on to production, right? I mean, I'm just going to read a quote here, from of course, I'm going to butcher this because I'm from Saskatchewan, but Kota Ikenishi, GM of the Battery Minerals Office for Mitsubishi, writes here that you have, we see a nickel, so he says, we are very pleased to see the positive PFS. We see a nickel project like Turnagain with low carbon intensity in a stable jurisdiction has a key role to play in the future of the nickel industry, in particular for the battery industry. We look forward to Turnagain's potential to be further verified in works ahead. Maybe the question I'll have, and you folks already touched on this, but I mean, what is the level of support, going through the PFS process? How much was Mitsubishi involved? How much are their fingers in this pie, I guess, is the question.
They've been heavily involved, and when I left my previous role, and came into the junior space with Mark, I thought I was done with some of the reporting aspects and stuff that I used to have to do in a big corporation. we've got a big corporation as a partner, and they've asked for a lot of things from me, which is great. I love having them as a partner. Every month, we're talking about this with their due diligence consultants who they've brought in because they admit they're not a mining company themselves. And they've been helping steer the entire PFS all the way along through those consultants. I'm dialoguing with them more than once a week. It's basically a daily basis at this point, and they have people dedicated to this project. I think they have, internally more manpower on Turnagain than we do, because most of our work, besides me, is outsourced through engineers and engineering teams and others. They've been heavily involved and very usefully involved.
Yeah, excellent. And again, I think that just comes back to this idea that, Mitsubishi did not choose you accidentally, right? I'm sure that they were keenly aware of every potential nickel project that they could have partnered with, and they chose you. And I think that, again, I mean, it speaks volumes to what you're offering that, again, maybe isn't obvious, that when you just look at those numbers. We're nearing the end here, gents. I mean, we only have a few minutes left, so maybe I might just kind of turn us around to the end here. But, I guess, what's next, right? So we have this positive PFS. I mean, last I looked at you were ticking up nicely, gently, kind of as news kind of was absorbed. But what can we look forward to, right? I mean, what's the next step for you, for Giga, that you will see this story continue to grow and progress?
Well, it is deal time. We've had a lot of strategics that have been waiting for this pre-feasibility report, and I think we've delivered something that is going to have a really good impact with that audience. So, just to give it some context, to get this project from here to a final investment decision, all the geotechnical drilling and other work that needs to be done, we will do more metallurgy, we'll do more geometallurgy, and we've got an entire environmental assessment to get through. It all costs money, and with really large projects, it costs a lot of money. So at this point, it's a bit of an arm wave, but I'm waving my arms and I'm saying to get from where we are today, final investment decision, will be about $50 million US. And again, in a context where our entire market cap is 25 million Canadian. So another disconnect, but we're looking to get that money by selling a part of our piece of the project, our 85%. Some of that is up for sale for that money to advance the project. That's a final investment decision. So that's what we're working on. Really, I don't want to launch into an environmental assessment until I know we're funded. I don't want to get part way into it and then stop. It's just not the way to go. And I'd like to get the money soon. I'd like to get the money committed before the end of the year, if that's possible. That's pretty ambitious. That may be too ambitious a goal, but I'd really like to get the money in by February at the latest, so that we can plan our summer program and hire drilling contractors and all that sort of thing. So that's what's next, is deal time. And, we're going to be running flat out talking about a lot of different.
Well, I can't help but ask as a follow-up, Mark, and obviously I don't expect you to divulge material information, but talks are in progress, I assume. I mean, can you provide any color or context on that in terms of number of parties or how advanced they are, or, that sort of conversations you've had around the PFS as is?
Yeah, I don't want to get into too much detail about that, but there's a significant number of parties involved. They include major mining companies, they include major automobile manufacturers, and they include battery companies. Some of them are fairly advanced, and they've got, we've got NDAs signed with them, so they could be in our electronic data room doing a deep dive into the data that's behind all of this engineering. Some of them were waiting to see the PFS before they decide whether to sign an NDA with us and do a deep dive. So just there's a lot going on.
Of course. Now you can tell me to buzz off, but can I even ask how many NDAs you've got signed? Okay, no, fair enough. You can't fault me for asking, right? Um,
Nope.
so one, we are, like I say, nearing the end here. I just have to ask, almost as just kind of sitting around the water cooler here. The Japanese trade mission announcements yesterday. Is there anything you want to talk about with those guys?
I didn't pay that much attention to it because we've just been so busy the last couple of days. But Lyle, did you notice anything there? Or?
I see that there's been some sort of a deal announced. Whether I always cast a bit of a skeptical eye over announcements of supply chain deals because they're often a little ephemeral in terms of time limited, and like, if you deliver this by then, we'll buy it. But is it actually feasible? There's one of those signed with the U.S. project a couple of years ago. Sometimes these announcements are made because somebody needs to get an announcement out to look good. Are they real or not? I haven't really spent any time looking at it. I still have a full PFS report to deliver, so I'm not done with the press release today, unfortunately. So
yeah, your feet aren't up on the kicking sand in Maui yet.
no, not yet.
So Matt, there's one observation I'd like to end with, if that's okay.
Yeah, of course.
And that is about Mitsubishi itself. They are thinking big. They are thinking about the entire battery supply chain in North America. And so does that mean that they're going to build a refinery? No. But they know companies that they've got friendly relationships with that might build a refinery, right? And that might build a refinery that would process Turnagain concentrate. Are they going to make PCAM and and cathode active materials? Probably not. But again, they know companies that have that capability. And so I can tell you that that's what they're thinking, and that's what, Lyle is actually an expert in this topic as well. What do you need to get it from in the ground to the cathode? What are all the steps? We don't have them in North America, and there's a lot of building that needs to be done. And I can just tell you, Mitsubishi's thinking big.
Well, I think that's a decent place to stop, Mark. I was going to ask you what your final thoughts were. I mean, honestly, I think that anybody out there who understands this future supply crunch as demand, hockey sticks vertical here for battery metals, anybody who believes that the green energy revolution is in play, I think that Giga Metals demands your attention on that front. So Mark and Lyle, thank you guys for coming on my show here. I appreciate your time today.
Thank you very much, Matt.
Thank you very much, Matt.
Thanks, guys.
Okay.
Yeah. Good luck, guys.